Hi, everybody. Thank you for taking the time to listen in today on another episode of Market Pulse. Mike Sorrentino here, along with Bepin. And Bepin, I got a confession to make. I'm not a big fan of reality TV at all. But when I was younger, when The Apprentice was on, I was addicted to that show. I
I
was.
think
I don't
most of
know
America
why,
was.
because I don't like that type of TV, but I was addicted to that show. And I think it's definitely appropriate given the fact that on Friday of last week, which is the big day for economic data in this country, uh, President Trump fired the head of a major government reporting agency
Yep. The Bureau of
and
Labor Statistics.
BLS, and it is something that has been well. I mean, he kind of made an accusation that it was politically driven in terms of why the data looked bad. But what we want to do is we kind of spend some time talking about that today and kind of potential implications of not necessarily her being fired, but rather some of the data that looks like it might tell a different story than what we might have thought about a couple weeks prior to all this coming out. So I love this quote from a University of Chicago professor who's an extremely famous economist that I actually was able to come across in my time when I was getting my MBA over from Ronald Coast. If you torture the data long enough, it will confess to anything. I love that quote because it's true. You can take something as simple as one or two data points or even a data series, and you give me the conclusion you're trying to get to, and I will back into that using whatever data set you give me. That's how easy it is to manipulate data. And that's a hard part of our job with that what Bepin and I deal with is avoiding the garbage in, garbage out situation you run into so often in this business. If the data is bad, your output can be bad. So a lot of times what we try to do is we try to look for ways to verify data along the way. And let's be honest. All right, so Bepin, I'm gonna take this as carefully as possible. Now, I can't comment for a million reasons on whether or not the head of the BLS was politically motivated. However, if I was her boss, I'll just leave it at that. I would have fired her too. Has nothing, and I mean absolutely nothing to do with politics. It has to do with the fact that the data that's coming in, it's being used, it's getting worse and worse. The methodologies that have been put in place for a long time, they are getting worse and they're not being fixed. That is the reason why I would have personally fired her. But at the same time, I want to back up my explanation. So it's not just the jobs numbers that were all over the place and had to get restated and even wide disparaging results. If you look at CPI, now CPI is Consumer Price Index, same agency that calculates CPI in this country. Now, you see it here on the screen. To calculate CPI inflation, which the BLS does, they actually collect around, I want to say it's like 90,000 price quotes every month from 200 different item categories. And there are a couple hundred field collectors out there, people that are going around, or I think it's like 75 areas around the country. But here's the problem, Beth, and I'm sure you already know this, but this is crazy. When the data is not available, the BLS staff typically develops estimates for right around 10% of the cells. All right, so you see that on your chart here, okay? That's kind of that 10% range from, well, actually, since recently. The short version is they guess. They literally guess. They guess on that 10%. Now, 10% of a data set that's being quote unquote guessed on, I would say it's not great, but it's also not necessarily damaging. Where it gets damaging is what you see over the past couple quarters. When you're talking about 30% of the CPI that we read every day, or I'm sorry, every month that comes out, 30% of it is a total guess. That's not good.
Mm-hmm.
You can't rely on data like that. Okay. So I think that's ultimately one example of the problem that we're dealing with is it's not just the jobs numbers. The BLS has a real problem in terms of how they collect data and how they actually use it. And you could see this in many ways, but I would say that there's kind of I don't want to at the same time defend the BLS, but what
There are
they're
reasons. Yeah.
their reasons. Like, they're relying on survey data. All right. So we've talked about this before in the past. There's hard data and soft data. Hard data is very observable. It's quantitative. It's very hard to screw up. It's very easy to collect. The challenge that the BLS is trying to deal with right now is soft data. Soft data is survey-based data. It's, hey, what are you thinking? And would you mind replying to my email or my phone call? And guess what? A lot of times people just don't want to reply. There's no
No,
gun in the back of their head. They're not required by law to respond to these surveys. And if they're not going to reply, then we've got a big problem. As you can see here, the response rate to current employment statistics surveys for a long time was kind of that 50 to 60% range. And today it's, called, a third lower. It's around closer to 40%. So,
Yep.
it is that garbage in, garbage out type situation, but it's also people just aren't replying to these surveys.
No, and if you actually want to ever go Google what those surveys look like, they're like 2 or 3 pages long. They send them to you monthly.
Super granular.
And
Yeah.
they ask you how many employees, what were their compensation, any bonuses, anything. So like you're really just giving them a breakdown of everything you just did in the last month. And guess what you're getting paid to do that? $0.00. It's actually just extra work. And that's actually the number one reason that's cited when companies are asked, why didn't you respond in time? And they said, I didn't have time and you're not paying me. So
Yeah.
very reasonable.
Yeah. There's no upside for them. But the reality is the labor market's cooling. And we've discussed this on and off for the past couple of months. It's not, I wouldn't say that the data that came out on Friday was overly surprising, to be blunt.
Yeah.
I think that and there are private market surveys that are out there and private market data that we've seen actually have been a little bit more consistent around this range. But a lot of times it's just boots on the ground, Bep. And I mean, I've got, yourself as well. We talk to people all over the country that I know a lot of people that own businesses, a lot of people on Wall Street that have access to resources that are a little bit better than what the government has. And it is somewhat universal. We've seen a slowdown. It's just that simple. We've seen a slowdown in employment. I don't think it's enough, in my opinion, to sound the alarm bells at all. But, and I actually think in many ways, given some of the investment that we've seen coming into the country recently, or at least proposed investment, what did we see yesterday, Bepin? Apple's going to be doing the glass in Kentucky.
Yep, they upsized their
Huge.
investment, I think, from 500 billion to 600 billion.
$600 billion. I mean, that's a huge deal. It's 52,000 jobs that are coming to Kentucky. I mean, so look, I mean, this is we don't want to take a very myopic view of the data. We see a lot of opportunity going forward, but it's hard to ignore the fact that we are seeing a slowdown in unemployment.
And I mean, that could honestly also be a great help to inflation, as employment, gets a little tighter, you don't have as much leverage when you're asking for that raise, and raises are usually paramount for inflation. That's what it's good for you, but might not be good for prices.
Yeah, maybe Chipotle will start charging $18 for a burrito.
They're already charging $18, man. Hence why we removed them from your portfolios, by the way.
Well, look, I mean, I think there's let's try to make lemonade out of lemons here. Exactly. There is a potential benefit to the job situation, and that is the probability for rate cuts. Well, let's go back to Friday. All right, Friday. Yeah. Going into Friday's data report, I forgot off the top of my head what was it. There's like a 40% chance that the Fed was going to cut in September. Yeah. And last I checked, Bepin, it was probably in the mid 90s now. I mean, it's almost a certainty. Off. Yeah, it's almost a certainty at this point. We got the Fed has no more. They've got no more excuses at this point. We've been saying that for a while, but now it's going to be very, very difficult for them to not cut. In fact, Bepin, I mean, I've been hearing the chatter I'm hearing is that originally we were going to be lucky if we saw a half a point cut by the end of the year. What I'm hearing now is that it's almost, I don't want to say a certainty, but a lot of talk about we're going to see a full point by the end of the year, full 1% cut in interest rates.
I know that all happened overnight. I mean, it's just been, it was a very crazy end to the week last week with the tariff announcements and then the firing of the head of the BLS. It was a lot of gyrations in the market. As you can see just on the odds here, it went from 40 to 80% almost in a snap of a finger at 10 a.m.
Yeah, and to your point, Bepin, there's a lot of things we won't talk about here in the plumbing of the financial system that went haywire after Friday. Now we don't feel that because it doesn't necessarily trickle up to to how we invest, but a
Yeah,
lot of craziness went had certainly happened. But if you think about it, let's say rates start coming down. Okay,
yeah,
why do we view this as lemonade out of lemons? Well, as rates come down, there's going to be a lot of benefits to the economy with cheaper money being made available. Look, everything in this, every major purchase that we do, take a step back. 70% of our economy is consumer spending, 18% is business. 88% of our economy is just us spending money. Now,
yeah,
most large purchases are done on credit. Okay, we take out a loan to buy a house, take out a loan to buy a business or a car, whatever it might be. If rates are coming down, that means it's cheaper to buy or to loan or borrow money rather. If it's cheaper to borrow money, that means we have an incentive to go out and spend more money, which is going to be a massive boost to our economy. So I do see a lot of benefits to the economy going forward, but it's not going to be as easy as, oh, I'm just going to go buy some stocks. Okay. It doesn't work like that. I think the biggest challenge that we're facing right now, and to be blunt, somewhat of a call to action in many ways, is the fact that for those that are sitting in cash right now, bank CDs, money market funds,
yeah,
I'm going to throw treasuries in there to a certain degree, even though that might not be as similar of an effect. Those
yeah.
days of 4.5% returns, say goodbye to them. Not forever, not forever, but I think for the near future, once we get into the fall this year, we're going to see cash returns move extremely quickly and not in the direction that you're hoping.
Yeah, exactly. And if you'll recall to the article that we put out last week talking about some cash alternatives to start thinking about getting your money working harder, it is a great time to reach out and talk to your advisor about some potential opportunities out there to really lock in some higher return for a longer period of time. So if you're sitting there listening to this and you're sitting on a pile of cash, reach out to us.
And don't wait. This is normally I say take your time when it comes to investing decisions. You got weeks, not months. Because
Exactly.
once these rates start moving overnight, the rates on cash overnight will move, not
Yeah.
over a couple days or a couple weeks. It will be literally within hours.
Minutes in cases, but
Yeah.
so I drew the short straw this time. Finally, my turn to talk about tariffs. And one of the big things we got last Friday was the update on the reciprocal tariffs, the final, I'd say final liberation day. We got the last announcements for major trade partners as well as a bunch of small countries who all got flat at 10% or 15, depending on if you're in a surplus or a deficit with us. The chart you're looking at right here is showing the new tariff imposed this year versus the latest agreed upon, which is that blue dot. That's basically the blue dot showing you where we ended up at. The orange line is showing you what the highest threatened amount was. And for most cases, you're looking at a blue dot that's well below the threatened amount, which is the amount that was mostly announced on Liberation Day, which had the world in panic for the most part, as everyone thought this could be the end of the trade system as we know it. And now, as Mike and I had been talking about before that, we saw that as entirely negotiation tactics. I mean, some of the rates that were getting thrown out there were flat out embargoes, particularly China. If you look there, the yellow bar doesn't even make it onto the chart because it was so high. 145% as we sit today. It's about 30. To be honest, China's it's actually turned out to be probably one of the more friendlier negotiations we've had is actually with China. Now, India on this chart is actually a little off. If you've been following, they just got another 25% slapped on them today, but that's more of a geopolitics thing than a trade thing. This is kind of to put a little bit more pressure on Russia with the Russia-Ukraine situation. One of the other things that we were talking about earlier this year was the first people to the table are going to get the best deal. And look who the first person to the table was. It was the UK. And as you'll see, their blue dot there at the bottom is the lowest it could be. And that was the advantage of coming to the table first. But the big overarching thesis around tariffs so far that me and Mike come to is that they're a lot better than we expected. And as you've seen the market react, we're back to basically all-time highs, even though the tariffs are getting implemented. So as you're seeing is the market is kind of looking past tariffs and starting to look at some of the more bullish changes to the market, whether it's tax cuts, whether it's rate cuts, like Mike was just talking about, that's starting to take center stage. And the big theme here would be to try to ignore the tariffs to some extent, but obviously they are going to be occurring, but there are a lot more drivers that could lead to further future growth than there are detractors. So let's just get this out of the way. If we look at this in a vacuum, tariffs will lower growth, whether it's around the world, particularly in the US. If we just look at tariffs alone, if we look at a world without tariffs, and then we look at a world with tariffs, the world with tariffs is likely going to have lower growth. But that's not taking into account some of the other things that we've talked about, which is primarily rate cuts. And obviously, as we mentioned on our last presentation, the big, beautiful bill. There are a lot of changes with the big, beautiful bill. If you look at this next slide here, this is showing you just what 4 companies are going to be saving in this current tax year on the tax law changes. I mean, if you add those up quickly, quick mental math here, that's about $50-60 billion between 4 companies that are in tax savings. And that's all going into cash flow. That's all going to be going into future reinvestment, future growth. The tax cuts are probably one of the biggest tailwinds heading into the next 2-3 years here. If you recall from the last time we saw tariffs, the biggest counter to tariffs was the tax cuts. You didn't even notice the tariffs. We mention that all the time. Remember when they came in 2018, 2019? Mm-hmm. You didn't even notice them because the tax cuts were just so much more overwhelming. And then you add in the rate cuts, which could be another fuel to the fire. Now, we're not saying that there isn't risk out there. Obviously, tariffs in some industries and some companies, it'll hurt dramatically. But for the overall U.S. economy or the U.S. stock market, we still feel confident in the long run. Those tax cuts are here to stay. Those rate cuts, once they occur, they're probably here to stay for quite a bit of time now. We're not saying that we'll never get back up to 5, 6, 7, 8%. That could definitely be in the future. Wouldn't be out of the cards by any means, especially with the fiscal situation we're looking at. But going into the next 3-4 years here, it's hard to imagine that taxes won't be contributing to earnings. I mean, these are estimated cash savings, but they're pretty accurate. I mean, it's a math equation.
Yeah, it's not hard to come to these numbers. Look at that, but I've used this example multiple times. To me, taxation is there's a very simplistic way of looking at this. If I earn $1, the more of that dollar I get to keep as a company or an individual, the more I have to spend or give to my employees of highest salaries or pay dividends or do something other than hand it to the government so they can light it on fire. That is the way you view taxes. It's a simple lever. So to your point, Bepin, the lower the tax rate, these cash flows are not only material, but this is just a representation of what nearly every company, not all, but most companies are going to realize as they go forward.
Yeah, very proportional. Obviously, if you're a $1 billion company, it's pretty hard for you to save $17.5 billion just on taxes. But
unless you're doing something shady.
Yeah, unless you're doing something shady, of course. And then you add in the rate cuts, and not only are the taxes giving you more money to spend and invest, now you got rate cuts making borrowing much cheaper, making borrowing to invest in the future and more facilities and more business lines. It becomes far more possible. But really, we think that these tailwinds are more than enough to overcome any headwinds we could see from tariffs. But obviously, there will be volatility, as you saw in a couple of slides ago there when we were looking at rates. I mean, the market flipped on its head in one data report. So there will definitely be moments that try these theses out throughout the rest of the year, where we see moments where there's panic or there's moments where there's sell-offs. But if we zoom out and we look at for the long game here, everything's setting up to be potentially one of the better bull runs that we've seen. And with that, we'd like to thank you for tuning in. As we mentioned, we're always here for you, so please feel free to reach out. And if you're sitting on cash, give us a call. Have a great rest of your day. Thanks for listening and have a good weekend.